Manishi Raychaudhuri joins us now. Let's understand what he's telling his clients to do in this kind of a market. Manishi, the classic wisdom is buy, and buy a lot when there is fear on the street. Is it time to buy the fear?
See, right now, Nikunj, buying anything in this kind of a market, and this is not just in India, but equity markets across the world, would be like standing in front of a running train. So that's obviously not one would recommend to any investor because for obvious reasons, there is huge selling momentum. Last time when I was engaging with you on this channel, we were talking about the big risk of monetary policy tightening. Now this geopolitical risk has joined in. The extent of this geopolitical risk was unforeseen, possibly even about 7 to 10 days ago. At this point of time, we don't know whether this would spiral into a military conflict. But the most obvious reaction of investors has been to sell and get out and wait for for clarity to emerge. So many stocks may be looking fundamentally attractive after a sharp downturn, but it's obviously not the time to buy because you are quite likely to get a better price tomorrow or the day after.
Manishi, forget the geopolitical concerns, but FIs have been selling into India. That happened in December when the concerns were not that large. Even the budget was decent. We have got a clear advantage when it comes to the earnings cycle. Why are foreign investors selling into Indian stocks so relentlessly? I mean, the outflow is even greater than what we saw, let's say, after the GFC crisis.
Yes. In fact, if you look at it from the beginning of October, FIIs have sold possibly, if I'm calculating this correctly, close to about $13 billion or so, maybe a little more over the last couple of days. And that, as you rightly point out, is much larger in terms of quantum compared to even the first 3 or 4 months around the GFC crisis in 2008. I think there are two concerns about India playing in the FII's mind. Number one, clearly the valuations, which were more than 2 standard deviations higher compared to the premium that India commands over its Asian or emerging market peers. India always trades at a premium, and partly that's justified because of the relatively higher return on capital and return on equity. But that premium in late 2021 had reached a level which was possibly rarely seen over the past 10 to 15-year history. So that's point number one. Second, in an environment of Fed tightening, and now, of course, other global developed market central banks have also joined in, like the ECB. Obviously, the developed market currencies, particularly the US dollar, are forecast, they're estimated to strengthen at the cost of the emerging market currencies. And it was perceived that India would be one of the losers because India is one of the markets, the economies with a current account deficit, which would likely reach around 2.5 to 3% in the near term. And that situation has actually got aggravated because of the oil price spike, where India is one of the the biggest importers. So, I mean, these 2 or 3 reasons were they were hitting simultaneously. So it was turning out to be almost a perfect storm for India. Now, if I look at some of the outcomes that we have seen, the rupee has actually been surprisingly quite stable. In fact, if one looks at the Asian currencies, it's possibly the Korean won. And Korea is a significant current account surplus economy, but the Korean won is one of the worst performers. The rupee has been quite stable partly because of the large forex reserves that the RBI has, and that in comparison to the forex debt is possibly about 150% higher. That was not the situation in historically, if you go back about 5 to 7 years. The situation on valuations, it has eased significantly, but of course, that valuation premium still exists. In fact, I think the Nifty is still trading at close to 1 standard deviation higher than the long-term average when it comes to the valuation premium over rest of Asia. So that situation, while it has corrected significantly, it has not corrected fully. In times like these, when we are dealing with multiple risks, monetary policy tightening and geopolitical risks which are unpredictable, it is natural for investors to move towards the safe haven destinations. And these are necessarily the developed markets. And that's exactly what we're seeing now. So this is something that we have to bear with for some more time. I mean, there's no escaping this, this period of FII selling.
Sure. Manishi, the one question that we are, toiling with, especially given the kind of fall that US equity markets have had, is whether this is a bull market correction or not. Or is this event going to, turn tide for the bull market, which has been, a rip-roaring one-way move up all through almost 2 years?
I know that there are specific technical definitions of these. The bear market, for example, is, I think about 20%, a decline of 20% from the peak. I mean, if I look at the 52-week highs of the Indian indices, whether it be the Nifty or the Sensex, it's just about, I think, about 9% down from those peaks, which were reached in late 2021. So by that definition, we are not technically in a bear market, but I would like to step away from these numerical definitions for now. I mean, even though the market is down just about 9%, there are stocks which are down a lot more. There are possibly stocks that are down about 25, 30, 40% from their recent peaks. Some of these stocks are cash generators. Some of these stocks are market leaders in their respective market segments. And therefore, some of these stocks have the ability to pass on the cost increases that they are seeing. If I look at the economic trajectory going forward, India still seems to be in a relatively early stage of economic recovery. And as a consequence of, when I put these two things together, there are certain sectors, there are certain stocks that clearly jump at us. And those are the kind of sectors that we are recommending to investors. Right now may not be the right time to buy into those. But, obviously, once we have a greater degree of visibility of, where the situation is leading to, there would be a significant crop of good quality exposures that may be taken on this market.
I just want to point out that the Dow futures have dropped 800 points after Russia announced its military action against Ukraine in a fresh salvo just right now. So the pre-market rates are indicating further downslide even after the fall that US equities have had overnight. 2% lower for S&P futures, 2.5% down for NASDAQ futures as well. Manishi, just in line with what you were saying right now on what to buy and where is it that you would want to hold on to positions, when it comes to Indian markets, would you say that this time around perhaps more bottom-up stories should be bought once the dust settles down?
Well, it'll be a combination. Our approach to stock selection has always been bottom-up, but at the same time, there are certain sectoral tailwinds which one can't ignore. And, as a consequence of those tailwinds, we think there are certain broad swathe of stocks in those sectors which would benefit. Now, obviously, the ones that would benefit more in those sectors are, at least for the time being, are the market leaders, the companies that have pricing power, or in the services sector, the ones which are able to win deals, the companies that are able to reinvent themselves. If you look at the banking sector, the companies that have better balance sheets and therefore are able to lend more and therefore take advantage of a likely capex cycle that's going to kick in possibly 1 year down the line. So yes, I think there are certain sectors which are appearing attractive, and within those sectors, one would have to look for the good quality stocks with the significant growth forecasts. To make significant returns.
Good morning, Manishi. We are of course interviewing you on a day where Vladimir Putin has announced military operation in Ukraine. We have seen a reaction in the equity markets as well as the commodity markets as well as the bond yields. I want to lean in on your experience and when you see these kind of geopolitical tensions, history has shown, yes, maybe there is high volatility, maybe there is knee-jerk reaction, but markets usually end up going up.
Of course, I mean, these geopolitical tensions, unless they really spiral into something big and they linger on, that is the danger that one has to be, very cognizant of. Unless we get into that kind of a situation, these are really short-term dampening effects on asset markets. And pretty much every asset, as you rightly point out, have reacted similarly, be it fixed income or equities or commodities. Um, but at the same time, if we're able to get out of this situation in a relatively short span of time, and from the initial indications at least, it seems that it's unlikely to spiral into a military conflict because, I think the Western world is relying on economic sanctions rather than military action. In that case, one has to again look at good quality stocks and sectors, as I just talked about. Um, Today, tomorrow may not be the right time because obviously we have to live with this, the severe degree of uncertainty and not knowing what can happen tomorrow. This kind of a situation, we have to live with it for some time now. But at the same time, I'm sure investors across the spectrum are beginning to do those calculations that, okay, the market is down 9 to 10%, but which are the stocks that are down 25, 30%? And among them, which are the good quality stocks, with good balance sheets and good management quality? And I think those calculations, those assessments would come in very handy once we have some degree of visibility about about the geopolitical tensions and how they could be sorted out.
Well, Manishi, appreciate your time. Well, markets
Thank you
meanwhile
very much.
there's no respite whatsoever. We've started gap down. The good thing is that we've not sold off further after a gap down, but there is just no recovery. I mean, there is nothing on my screen which is telling me. I mean, not even a single FNO stock on my screen is in green.